everyone's here not only for the CFA recipients, but you're here to hear Don. Don Rissmiller is the speaker tonight. He is the vice chair and chief economist at Strategas. He is the founding partner and has served as the firm's chief economist since 2006. Prior roles include an economist for the Federal Reserve Bank of New York and economics research at ISI Group. Don, with that, I'm going to turn it over to you for your presentation.
Well, thank you very much, Ashby, and let me thank the Society for inviting me to speak here today. So I'd like to give an overview of what we're seeing for the U.S. economy, for the global economy, and try to give you some foundational elements that you can use in your day-to-day businesses. So to start off, I would say the global economy has been quite desynchronized over the past year. So there are places we look where there's a legitimate hard landing going on. That would be a country like China. When we look at a country in Europe, like Germany, you have negative GDP prints. Europe overall is basically flat. And that stands in stark contrast to what we have in the U.S., which has outperformed most estimates over the past years, ours included. So the U.S. is a standout. The U.S. is doing exceptionally well when judged by what the forecast was of what could happen, but also judged by other countries around the world right now. So to talk through this, I'd like to make 3 points off the bat. First, the risk that the U.S. has to growth at this point is probably what has already happened. So while the U.S. is outperforming other countries, there are still lagged impacts of prior policy that have to filter through the system. Having said that, I think most of those issues will be resolved by the middle of this year. The last Fed rate hike was in July. So by the time we get to the summer, not too far from now, we will be a full year past the last Fed hike, and we will most likely be looking at Fed rate cuts by that point. So even accounting for long and variable lags, there is still a time element to consider. The way this has happened, my second point, would be that the U.S. has cut job openings instead of jobs. That's how we are continuing to see economic growth. This fits with a labor hoarding story over the past several years. So managers and firms had trouble hiring. And after having gone through that in 2020 and 2021, even 2022, in 2023, they were very reluctant to separate from those workers. So they were willing to cut hours. They were willing to cut temporary employees. They were willing to do other things, but we have not had layoffs pick up. So the labor market has adapted in a very unique way this cycle. That's been important. What that leaves us with is a still very low unemployment rate. And I'll talk through that and the implications that could have for inflation, especially in the future. So let's take these one at a time. First off, the U.S. has been outperforming. We would expect GDP growth to slow down. We were running around 2.5% for last year, for the year overall. This year could slow down to something more like 1.25%. And so one of the reasons for this is that we have to digest what has already happened. So this chart is corporate profits. That's the blue line, and the red line is the Fed funds rate change lagged 6 quarters. So this is a graphical way of expressing that monetary policy hits the economy with a long lag. And we are still digesting that. However, you can see it's starting to turn back around, and by mid this year, we'll be moving past the worst, even of this chart. Another issue in the past year has been what has happened in the banking system. And If we had had a bank failure last March, and I think we were close, we were probably within a weekend of that, the textbooks would have probably been written about 2023 and said something like, the Fed tightened 500 basis points, a bank failed, and we had layoffs. And that would have surprised very few people if that had happened. Having patched the banks, and this was a joint effort by the Fed and the Treasury and the FDIC and others, we did not have that happen. But we still had banks tighten lending standards, particularly to smaller businesses. And the chart I'll show you here is permanent job loss, that's the blue line, versus banks tightening lending standards. The sub-series we're using is the tightening of lending standards to small businesses. We use small businesses because those are the businesses most in need of banks. So they don't have access to the capital markets. They might have access to private credit, but they would also be bank dependent. What we see is when banks tighten lending standards, often you get permanent job loss. And that would not be surprising. In fact, the bank lending standard tightening leads permanent job loss by several quarters. That has not happened as of yet. And so this is where the labor market has to be considered somewhat unique in this cycle. Is it labor hoarding? Is it something else? And so a data set we've looked at frequently is the JOLTS survey, Job Opening and Labor Turnover Survey. This has data on job openings as well as quits and other series. And we just got this week, and the latest data shows us that we have still 9 million job openings in the U.S. The issue is we have 6 million unemployed people in the U.S. And so we have a ratio of job openings to unemployed that is still well above 1 to 1, about 1.4 to 1 right now. Even a ratio of 1 to 1, if we had one job opening for every unemployed person, would probably be considered tight when we talk about the labor situation. It would be a tight labor market because the individual that's available may not have the right skills, may not be in the right place, may not be willing to move. So starting from this position where we have many more job openings than unemployed people gives us a cushion, and it's a cushion that has been used over the past year. You can see the job openings number is coming down without a big rise in unemployment currently. Now, I want to talk through this chart in some detail because if I were to think about what the issue distills to over the last year, it comes down to the relationship between job openings and unemployment. So the y-axis on this chart is the job openings rate, the x-axis is the unemployment rate. This is a standard Beveridge curve framework. And the key is that it's a curve, not a line. And I think that's an important distinction for the last year and most likely for the next year. So you can see this channel that we have here, these two red lines. That was the traditional curve. That was the traditional relationship. And then when the pandemic hit, we got these scattered dots up and to the right. And so one potential conclusion was that the whole curve had shifted up, that we had established a new range for what was happening. Fortunately, that was not the case. And what the data over the last year has shown is we migrated from these very high unemployment rates back into the upper left-hand corner of this chart. We got there by 2023. Once in this position, we were back on the traditional curve. And from this starting point, the upper left-hand corner, we're at the steep part of the curve. So we can have big moves in the y-axis and only costing small moves in the x-axis. So large changes in job openings are only associated with small moves in unemployment when we start from here, when we start from the upper left-hand corner of this relationship. So it was fortunate that we had unique starting conditions in this cycle where that's where we wound up. We did not shift the curve. We were able to preserve the old relationship, and we've spent the last year moving down the Beveridge curve into the position we're at now. And so I would say I care about this, but even more fundamentally, I would like to argue that I believe the Federal Reserve cares about this. And I think that this has helped inform Fed policy as well as other central banks' policy over the last year. This is a quote from Fed Governor Waller just a few weeks ago. So this is up to date. And you could see Waller talk through some of these relationships and how they've influenced Fed thinking, with the conclusion that's highlighted in red here, saying that the vacancy rate hits an inflection point around 4.5%. And so if we go back to our curve here, that makes some sense. Here's 4.5% right about there. We're just a little above that, a little above 5 right now. What happens here is you bend. Right, so this is where it's a curve, not a line. That's the inflection point where we're going to now have to see rising unemployment if we're going to get any adjustment in the labor market. We've done the work, cutting job openings, not jobs. That can probably work till around there. And then we're going to hit this part of the historical relationship. So this helps explain where we've been. It says we have a small amount of cushion left, but once we get to about a 4.5% job openings rate, we know we're reverting to a more traditional regime. It also informs which leading indicators we can put the most weight on right now, I would argue. So this is a list of leading economic indicators that we've watched for a long time. We've used these to signal inflection points. There was a point last March and April when everything on our recession checklist list was checked, except the labor market. The one exception all of last year was weekly jobless claims. They were very good in telling us that the economy, even in the face of a banking crisis, even in the face of spillover from that crisis, was not seeing significant cracks. There were small cracks, but not big cracks in the labor market because initial jobless claims never moved enough to become recessionary. Since then, other indicators have actually backed off. There's still a few things that are checked. The yield curve is still inverted. If we look at the ISM data up until today, that was still negative. But other things have moved from concerning to much less concerning over the last few months. But I would have to put a star next to jobless claims as one of the best leading indicators we have. I would also put a star next to credit spreads. I think they did a very good job last year at signaling the lack of contagion from some of the financial events. So let's, when we go forward, do more of what's working, less of what's not working. We'll put more weight on jobless claims and credit spreads as leading indicators because those are telling us about some of these unique starting conditions. Here's the picture. If we had jobless claims above something like 260, that's where we got to in the summer, I would start to become more concerned. But the 220s type numbers that we're getting over the last few weeks, I think that's fine. Realistically, we could probably get up to 300,000 and not have too much concern here. So that's the first set of points. The U.S. has been outperforming. The U.S. had a strong year relative to expectations last year. There's still some risk in the first half of this year, but by the second half, we should be moving past most of those lagged effects. We've been able to do this because of some of the uniqueness in the labor market. Is there a cost to this? We're talking about very unique starting positions. Are there any unique ending positions when we talk through this? And I think there are. I want to talk about inflation as the cost. And so avoiding a recession at all cost can cost something down the road. That would be the takeaway. This is still not free. It is not that hard to get inflation down. Even in the 1970s, inflation came down 3 times. It was hard to keep it down. And so inflation generally comes in waves. And for a long time, for the last 15 years, we've not had that behavior because inflation's been low and stable. But that's not always true historically. In fact, it's more often the case that when you see one wave of inflation, you get an echo. And I think this has to do with how contracts are set. You might have a labor negotiation every few years. You might have an annual subscription. You might have an annual rent contract. those things need to turn over to see the full effects of inflation in the system. And so inflation staying down is the key for declaring victory at the Fed or any monetary policymaker saying that they have achieved their dual mandate or even single mandate in the case of some central banks that have inflation as their focus. So let me talk through this with some additional data. So this wave of inflation looks to be over. I will submit that. Here's the CPI, current data in the blue line. The other series behind it, the thinner lines, are other times when inflation has gotten above 6% in the U.S. historically. There aren't a lot, but we could look right after World War I, right around World War I, right around World War II, and then the 1970s. And so what we see is in the U.S. data, there's an echo wave in all of those cases. So if I were giving you an inflation forecast 5 years ago, I say I expect inflation to be 1.8%. I might say I expect inflation to be 1.8% next year and the year after and the year after that. I think that would have been a reasonable forecast 5 years ago. I don't think I could give you a forecast like that today. If I give you a forecast that's the same number for any duration, say 3 years, I think it would be something that does not fit with the historical way inflation has behaved. If I give you a forecast that was 1, 7, 2, that might fit. But there has to be some variance. The other moments of inflation are likely to be different because of this historical behavior. I think we've had this type of regime change. Now, a takeaway is the second wave doesn't start right away. Because of some of these lags that are built into contracts, the lag here can be a year or two. So the fact that we've just finished the first wave would say we're in the sweet spot for 2024. This is not the year where we get a big reacceleration in inflation right away. This is the year where we might establish the conditions, like a continued tight labor market, that give us concern down the road. Now, we asked, is this a U.S.-specific phenomena or not? And the answer is basically it is not U.S.-specific. It is a very generalizable statement. And so what we did here is we took 24 different countries. We took all the inflation data we had. We went back as far as we could go, and we said, what happens when inflation has a first wave? What happens when it gets above 6%? And the conclusion, if you look at the lower right-hand corner of the table here, is 87% of the time, if you have a first wave, you get an echo. If you have a first wave, you get a second wave, the vast majority of the time. So I would use that to set up the base case or the default case. It doesn't say it has to happen, but it says if you do nothing, this would be very likely. And it would be very likely because you'd maintain some of the tightness in the market going forward. And this was really the big problem in the 1970s. So what we have here is the Fed funds rate. That's the blue line versus the GDP deflator, so we can have a long, consistent series. Inflation came in waves, and the waves accelerated. So in the worst case scenario, not only do you have a second wave, but the second wave is above the first wave. And that can happen when you get unanchored inflation expectations. So if I had a perfect data series, what I'd really want to know is what are firms doing when they write multi-year contracts in the last year. Right, so let's say I make widgets, I'm going to sell them to you. We're going to agree to a 3-year deal. I don't so much care about the first year, because that's probably backward looking. So prices going up 10% for whatever reason. Supply chain problems, the factory burned down, it doesn't matter. Year one is a big number, but as long as we accept it, that is what it is. My question is, what is year 2 and what is year 3 in our contract? Because if our price structure goes 10%, 4%, 2%, that's our contract, that's anchored. I don't have any problem with that. I don't think the Fed would have any problem with that. But if we write a contract where the price structure is 10%, 9%, 8.75%, if somehow today we're agreeing to an 8% price increase 3 years from now, and that's in a contract that's enforceable by law, that starts to pull the anchor. That doesn't look stable. It doesn't look stable, first of all, because the number's plain old too big. 8 is not the target. But more importantly, that's our starting point for the next 3-year contract. So if you get towards the end of that contract and you have any shock, could be an oil price shock, could be a drought, could be a war, could be a supply chain problem. If you think your price structure has to go up, it's starting from 8 at that point. And so that's how I think you generate the second inflation impulse. And that's what happened. We had several oil price shocks in the 1970s. And not only did inflation come back, it accelerated. So the old idea of a natural rate for unemployment or capacity utilization was a NAIRU, a non-accelerating inflation rate of unemployment. So this is the most dangerous situation. And this was called the stop and go monetary policy of the 1970s because the Fed never got the anchor quite right. And this is why I think they're being very careful today, why they want additional data, why they're asking for time to gain confidence in what the inflation picture will look like, because they know it comes in waves, and they know the first wave's over, and they know inflation's down, but it does not necessarily mean it stays down. Now, there's another side here which creates what I would call an additional threat, meaning something else that could drive inflation up. And it's the fiscal side right now. So monetary policymakers, I think, are well aware that inflation comes in waves. They made this mistake in the 1970s. They probably will be conscious of it and not do it again. I was just in D.C. last week, and it is not at all obvious to me that fiscal policymakers believe inflation comes in waves and that they need to be careful here. So this is a list of policies that we have employed anytime the economy's gotten in trouble in the last several years. And it's a long list of acronyms. So anytime the economy has gotten in trouble, we found an acronym to patch it. Oil prices go up, you drain half of the SPR, the Strategic Petroleum Reserve. Get to the debt ceiling, you drain the Treasury General Account. So just in the last few years, we had a strategic reserve of oil and we had a strategic reserve of money, and we've used both of them. When interest rates got to 5%, the Treasury quarterly refunding announcement came out, changing whether we were issuing long or short relative to expectations. Interest rates came back down. We get a bank crisis, we create the BTFP, the Bank Term Funding Program. That didn't exist a year ago. Another item that's been important in the last year is the Employee Retention Tax Credit. This is an item that's left over from the COVID programs, but it's a tax credit, so it just depends who files. It's not really a budget item. And so this exceeded our forecast last year by about $150 billion. It was widely advertised. The program was actually paused because there's some concern about fraud at the moment. And so it could be restarted. It could be packaged into some other bill. It's being discussed in the context of a child tax credit bill currently. There's student loan relief that will likely resurface this summer. There's the infrastructure spending from bills we've already passed. So we have had very aggressive fiscal policy here. These are the CBO projections for the budget deficit out 10 years. This goes out into the 2030s. And you see no movement from the current numbers. So I've had it phrased to me that it looks like we're getting the best economy a 7% GDP budget deficit can buy right now. And I think there's some truth to that. And what the forecasts show is there is not a plan to change this anytime soon. The current projections maintain a very large budget deficit into the medium term. And they do it with an economy at full employment. So if you think about where we should be on the budget with a 3.7% unemployment rate, if we go back to the late 1990s, we had a low unemployment rate like this. There was actually a surplus. It's a very short period of time we had a surplus. But I was working at the Federal Reserve Bank of New York at that point, and there was research going on how to conduct monetary policy if we paid off all the treasuries. So needed to have that just in case we had a surplus into the future. Well, we didn't have that problem. We have plenty of treasuries here, and it looks like we'll have plenty of treasuries out into the future because of this very aggressive fiscal policy at full employment right now. Where is it showing up? Well, here's one of the more obvious places. And again, I'm defining fiscal policy as direct government spending, but also policies that encourage and cushion the private sector, like the Strategic Petroleum Reserve or trade policy. So this is the construction of non-residential buildings by type. So you have a variety of things in here, power and communication. You also have manufacturing. These are manufacturing buildings. So our manufacturing production has not had a good year, but we are putting in place new buildings to do more production in the future. So these are not active yet. These are just being built. And you can see that this has gone straight up. It's up over 80% on a year-on-year basis. So this is a place we're seeing some of the fiscal policy framework impose itself on the U.S. economy. We are trying to do more manufacturing, and we are very likely to do it because the buildings are being built at this point. Here's another item that's been important over the last several years. So this is real personal incomes. This is inflation-adjusted personal income. The blue line is without transfers. The red line is as reported. And so you can see the shaded bar is 2020. Here was the big hit to personal income when we had the big surge in unemployment. A textbook fiscal policy would have been to fill in this missing triangle. I don't think anybody would fault fiscal policy for doing that. So what actually happened is not only did we fill in the triangle, we added another triangle on top of it. These charts are supposed to match. They're not supposed to be mirror images. It's only in very odd situations that you would get that type of pattern, but that's what we had. This was the CARES Act here. Again, I don't think anyone would fault policymakers for that. That was a very uncertain time. It was a very aggressive response. It was probably an appropriate response. The issue is it wasn't the only triangle. And so you can see as time went on, we continued to add. This was 2021, where there was another $1.9 trillion package passed. And so for the last 4 years, there's been no recession in personal income, even adjusting for inflation. We had a downturn in 2020 where personal income went up because of transfers. And this generated excess saving that's been in the economy since, and it's probably dwindling at this point, but this has been an important cushion as well. So does this have any future implications? What I'd like to do to discuss this is to go back to the labor market and say, okay, we know we had a story about job openings that was important. That's probably getting towards the inflection point where the beverage curve is going to curve. So what is going to happen in the labor market next? What I'd like to show you here is the unemployment rate for every economic cycle back to 1949, where we're going to start the chart from the peak in unemployment and then roll time forward. So the bottom axis here is in months. And what we're asking is, how does unemployment evolve from the peak of each cycle going forward? So one thing you see is the chart goes out 120 months. So we have had some very long economic cycles. It can be done. But in those very long economic cycles, often what you have is you start high on unemployment, say around 10%, and then you come down slowly over the decade of that expansion. So you're always eating into slack. You're starting with a high unemployment rate, and taking the unemployment rate from 10 to 9 doesn't generate inflation pressure. Taking it from 9 to 8 doesn't do much, 8 to 7, and so on. Problem is when you go from 5 to 4 to 3, you hit a point where you do generate some stress. And often that point would be many years out. But in this cycle, we had a very high starting point, but we brought the unemployment rate down remarkably quickly. So the unique starting conditions of the cycle give us this unique ending condition, which is we've been bumping along the bottom of our historical range for unemployment, the 3.5 to 3.9% range, for the past year. We got to that 3 handle very early in this cycle. So the labor market is sitting in a tight position naturally here, and will most likely continue to do that out into the future. So Is there a way out? The concern here is we're going to generate a second inflation wave if we keep this up. Can we decapitate the second inflation wave? The answer is yes. There are policy ways to do it. The Fed could stop a second inflation wave. The challenge is, because we've used up the beverage curve argument, the only way they have left is to increase unemployment. So we don't really want that to happen. If there's another way out, it would be preferable. And so at this point, there's a lot of interest in any story related to technology, I think, because that's the private sector helping the Fed to try to remove some of this pressure. We're starting with a low unemployment rate. Then what we're saying is we need each worker to produce more. We need productivity to go up. And we measure productivity as output per hour in the non-farm business sector. We have a long time series on that. And we are starting to get some improvement here. In the 1990s, it went on for the second half of the decade, so it needs to continue. But 3% productivity would help a lot. If we can maintain a pace like that, that's more growth and less inflation at the same time. So instead of having too much money chasing too few goods, the better plan is to up the goods, get productivity up. So this is not really the Fed. This is the private sector. The private sector is going to have to help the Fed by increasing productivity in order to decapitate the second inflation wave. One is much more friendly, and that's why I think there's been a lot of investment interest in something like AI. I expect that to continue. We can certainly talk about that in the Q&A if people want to dig into that some. But that is the framework that I'd want to set up. We have some unique ending conditions that are a labor market that's still tight. Naturally, that would generate concern about inflation several years out again. There are ways to stop it, but the best way to stop it is to get productivity up so we increase our output per hour. So with that, let me stop there, and I want to take your questions and be as helpful as I can here tonight. I believe there's one in the back there. Yeah, just to repeat the question for anyone who couldn't hear, we're asking about leading indicators. We had highlighted jobless claims and also credit spreads. I'd say the issue in my mind is just the direction, first of all. So if we are narrowing credit spreads, that's not consistent with a financial crisis or an economy that's contracting. So we're at very narrow levels depending on which ones we want to use. If we use BAA spreads, a 50 to 75 basis point increase would be just a start. Something like that I think would be a signal. But I need widening, and what I have is narrowing to check that box. And we've had stable or narrowing for most of last year, which is why I would put it on the signal list of things to watch from here. Yes.
For not terming out the deficit and, essentially refinancing at crazy low interest rates, which we've been through. Do you have an opinion about why they didn't do that?
So there is a Treasury Borrowing Advisory Committee that talks to the Treasury regularly, and the simplest answer is there was a desire, if you're going to go long, to have repeat issues. So if you're going to have a 50-year bond or something, you'd want more than one. Or do you want to be able to have regular issues at that maturity? There was not a lot of confidence you could have regular issues at the very long. You could have an issue. You could probably find a buyer, but can you find repeat buyers? And so if you don't have that, you create different liquidity premiums that are undesirable. So that's the technical answer. I'd say the political answer was also, when you have a normal yield curve, it's more expensive. So if you have an upward sloping yield curve, today it's going to cost more in a normal setting when you have an upward sloping curve. So there's a very short-term political angle that you have to satisfy, that you can reduce what you are paying right now by funding short rather than long in a normal environment. We've had an inverted curve for a while, and that still didn't change some of these arguments, though. So I think there's a technical disinclination, and then there's a pretty real political barrier to doing it. But the third point I'd make is there's been very little net cost, meaning we are paying money in our own currency, which we print, and so this. The way you get into most trouble is you have debt not in your own currency and owned by foreigners. And we have debt owned by foreigners, but it's in dollars. And so having the dollar as the reserve currency has been a positive, in the sense it's let us attract a share of the world's capital relatively cheaply. But the cost of it is you get no signal going to DC that something might be up. So you can pretty much run your plan however and not get any immediate cost. So a second question here.
I'll bite on the AI and
Yeah.
Productivity side. Would love to hear your thoughts on how Strategas and yourself view the impact of that with large language models, and the impact on employment and the impact on productivity.
Yeah. So let me take it in two parts. Let me talk about the AI specific piece, and then I'll talk about the labor piece. So one of the things that's been good for our firm in the last year is all the travel has reopened. So I've been able to go meet with a lot of our clients. I happened to be on the West Coast last March and April as the AI story was really getting going. And so got to meet with a lot of people that were in the space. The striking thing that I saw was not that the language model could write a paragraph, because everybody expected it to do that. It was that it was writing a really good paragraph. And that was not really in the original design. It was designed to look at 4 trillion examples and then guess the next word. And that can give you a sentence or a paragraph, but it doesn't explain why it's writing like Shakespeare quality, like sonnets. And so the light bulb that I think was going off at the time in Seattle and San Francisco was, what we're doing is we're finding that language, good language, has an inherent structure to it. And so what the large language models are doing is they're finding the structure and replicating it. They're returning it to us. So it's more like an X-ray machine than a language model. It's looking at a big data set, it's X-raying it, and it is returning structure if there is any. Language happens to have structure. Good language happens to have a specific structure, and that more or less fits, I think, if you think about it. If you think as a human, how do you become a better writer? Well, one good way is to read a lot. And that's what this is doing. Because by doing that, you create associations between different sentence structure, different paragraph structure. So that's the power. And that's why I find it exciting. And I put the productivity chart up there that's increasing, because this has the best shot of being something more like the 1990s. Versus anything we've talked about, I think, in the last decade. So there have been tech stories in the last decade. There was the Web3, there was the metaverse, there was 3D printing. Some of them work better than others, but they were all somewhat nichey. They were narrow. If you have an X-ray machine for structure, it should be very broad. If that's what we're talking about, you can apply this to any big data set. and it should return structure if it's there. So it works with language. That's what we've shown. That's the test case. Well, let's use it on organic chemistry. Let's throw in 4 trillion molecules and ask it if there's any structure to good cancer drugs, and if there is, return the top 100. And I'll give that to the best research scientists who already know how to test. They just can't test 4 trillion. Might be able to test 50. So that's productive, and that could be very productive. If I'm designing a subway system for a city, have the AI look at everyone in existence and return the best structure for this town, so the station goes here, not there. That might be a better way to make decisions than the current system, which is inherently very political. It would be a way to get around the politics of some of these. The AI said it goes here. That's a pretty powerful statement. So I'm very hopeful that we found something that can increase productivity in the private sector, but it should show up in the users of AI in addition to the producers of AI. It can't just be the producers that profit. It has to be broadly profitable. Sir?
Yes, this is Tom Phillips with UBS Institutional Consulting Group. Do you have a forecast for the S&P 500 for the year?
I don't. About where it is now. I don't have a forecast for the S&P 500 now. Other questions?
So back here in the very back, you touched on the world economy, and you haven't touched on it too much since then. I'm wondering about China. How bad is it? We saw a massive bankruptcy this past week and didn't hear too much about it. And what's the impact? How bad is China, first of all? And secondly, what's the impact on U.S. inflation?
Yeah, both great questions. So I would say it'd be very difficult for China to surprise to the downside by the same amount it did over the past 12 months. In other words, the expectation a year ago for China was the economy was reopening because it was coming off a still pretty substantial lockdown. And if China GDP last year was 10, would we have been shocked? I don't think so. The shock was how it grew, but did not grow much above its trend growth rate. So from here, I think there's been a broad recognition within China that there needs to be something addressing this situation. If you put 5 China analysts in a room for 6 hours, they could probably come up with a policy that would help. But it would most likely be some sort of consumer stimulus. There's been a political reluctance within China to pursue such a policy because it would probably come with debt. Okay, so the type of stimulus we're getting has been more in the historical framework where you try to stimulate exports, you try to stimulate construction, but that's really tapped out. There's not a lot left domestically. Fixed investment is very high relative to GDP. And so if you wanted China to grow faster, what you would do is try to take the consumer sector and have that behave more like other economies. So take it from 1/3 to 2/3 of the economy. And that is available, and that probably would work, but I am not holding my breath that the current government in China will do that. And they will likely not do it for purely political reasons. I don't think we're optimizing China on the economic vector anymore. I think there is still economic growth, but it's resultant from policies that are being pursued because of different types of approaches.
Hello. I guess the mic's on. I've got a question about the looming crisis in commercial real estate, particularly office properties. Do you think the banks are prepared? The banking regulators, the Federal Reserve. What do you think the implications are going to be for the overall economy as this unfolds over the next 12, 18, 24 months?
Yeah, it's an important drag. It does not look like it's a systemic risk for the big banks. So that's what's different, let's say, than 2006 or 7 or 8. It is a significant drag for smaller or medium banks. So the agency that's going to deal with it is going to be perhaps less the Fed and more the FDIC. We do have a way of dealing with smaller bank failures. We just have trouble when big banks get in trouble. So I don't think, there isn't anything I see that says it's going to be that type of 2008 type scenario. It's going to be a long drag, probably over many years on some of the smaller banks. So in addition to that, I would draw a distinction by type. So it seems like office is impaired. And the question is that impairing other? So can you make up within a portfolio, you have your office building that's impaired, but you also have a healthcare facility and a data center, and those are still performing. I don't think you have a full offset with that type of framework, but that helps, that it's not as broad as it could be. There's still some structural growth areas because of demographics and healthcare, because of technology and data. It's also very regional. So even within office, if we look at some of the states that are growing, the cities that are growing, you still might be okay in that package. So I view it as a risk, but a known risk, not a systemic risk, but something that will linger in the economy for years here, most likely. And I don't see the interest rate profile coming down enough to undo that risk. I think the Fed cuts rates. I think they probably start in the second quarter. I think it's a rate cut cycle. I don't think 5.5% is a neutral interest rate. I think a 3% interest rate could be a neutral interest rate. But you have to get the short rate down 225 to 250 basis points. And even then, you probably won't remove all the pressure. And I don't see that happening fast enough. That's a 2-year process to come down several hundred basis points in Fed funds. Yeah. So, so I work in our New York office. Dan Clifton works in our DC office, and I'm very happy to be in New York and not DC for this year in particular. So, it looks like be the longest presidential election cycle that we're going to have. Usually you get to Super Tuesday before you have really the mainstream attention on this, but it's going to be a long cycle. It's a very combative cycle. The world probably looks quite different depending on who wins the presidency. There are a few places where it will matter less. Let me go there first. So we talked about China, like trade policy. I don't think it much matters. I think either a Biden administration or a Trump administration would pursue a trade policy that's more restrictive, especially when it comes to parts of Asia. The tools might be different. You may use tariffs, or you may use regulatory policy in the Biden administration, restrictions on chips, restrictions on technology. But the deglobalization is a strong term, but it's not wrong. We're moving away from optimizing on efficiency to optimizing on robustness. So I think that we can say. There are a few things we can say probably are going to be outside the scope of this election. But then it gets very contentious very quickly. We're going to move quickly to a 2025 tax bill. That it's going to be heavily dependent on who wins here in November and what the composition of the House and Senate are. So it's going to come down to a few states, as it has in recent times, and how the swing voters in Pennsylvania and Virginia and Arizona and Colorado and Ohio and Michigan vote. And so social issues probably matter in this election. I think that will be a big factor. I think the economy will be good enough where it matters a little less. I don't see a big pickup in inflation. I don't see growth weakening enough for that to be the swing factor. I think it's going to be decided on other factors. Yep.
One of the questions for Mr. Powell yesterday was, why do you think people are so pessimistic given that everything is going so well? Unemployment is down. It looks like the CBO is projecting deficits for the future, so everybody will have plenty of money. Child tax credit got passed today. Why do you think everybody is so pessimistic in one of the most optimistic, in my opinion, environments in the last 20 years?
Yeah, so I think there's a couple ways we can attack this. So if you look at optimism by party, it is kind of what you think it might be. The party that's out of power is more pessimistic than the party that's in power. But additionally, I do think people pay attention to the price level in addition to the inflation rate. And the price level is still high. Right? So if it were a supply shock where you couldn't get used cars for a year and prices went up 40%, which they did, and then you cleared that and they came back down, but we're back to the old price level, that would be one thing. But that's not what we had. We had a shock where the price level moved out, and it's staying there. So I think some of the pessimism is coming from a price level that is still high, and people find that unfamiliar, and still, especially in some essentials, food, energy, transportation, autos, those prices seem unfamiliar, and I think that's affecting confidence. The final point I'd make is I think there is a sense in which we know that the way we're getting growth is with debt. And that works. It will generate GDP, it will generate activity, but there's a cost. And I think there's some, at least for some individuals, a worry about that cost over time.
Hey, thank you for speaking to us. I was hoping maybe you could synthesize a couple things that I've picked out from what you've talked about. Basically just demographics, right? We've talked about productivity. We've talked about sort of regional demographics. We've talked about, whenever I think of China, I think of poor demographics. But just, when we sort of zoom out a little bit beyond with productivity and whatnot, any sort of commentary on demographics, headwind, tailwind, et cetera, and how that kind of plays into this? Thank you.
Yeah,
if you can.
absolutely. So globally, this is a very important question. Japan is shrinking. Europe looks like it will probably be Japan going forward. The U.S. has better demographics, and immigration is a part of that. China does not. So demographic forecasts, especially out multiple decades, are actually quite good because they're essentially just actuarial tables. Barring some big disruption, a geopolitical event or something, they're quite accurate. And if you look out to out several generations, let's say out to 2100, China is set to lose a U.S. It's going to lose about 380 million people in some of the demographic projections out there. It's big.
I'm going to say wow for all of us here. Wow.
Yeah, so now it's still going to be a big populous country, but I think demographics would say you may want to look beyond China. Maybe you want to look to India. Africa has good demographics. Middle East has good demographics. The U.S. is kind of more neutral, but it's going to be an important global factor in Asia as well as here.
Yeah, I was really interested in your chart, the idea of the inflation echo and rebounding and the high probability of a resurgence in inflation. And you suggested that we may be able to overcome that by improvements in productivity over time. But productivity notoriously is kind of not linear. It's often not broad-based across the economy. So I'm wondering if you're expecting the Fed to drop rates this year, is there potential for a policy mistake? Because everything has to work in a timely manner and almost kind of perfectly to achieve the outcome you're looking for.
Yeah, no, you're right. Productivity is easier to assess in hindsight than in real time. There was a story in the 1990s that the computer was showing up everywhere except the productivity data, because it took about 14 years for the technology we had to get fast enough, broad enough, and then linked together enough to really give us the productivity gains that we saw. The hope with something like AI is it's built on our existing infrastructure. So what's different is we don't have to go wire every building. You just use the cloud. In other words, if we can design this correctly, it can work on your phone. It can work on your computer that you already have. So instead of 14 years, could it be 4? That has to work, because 14 is too long for my inflation chart up there. But it has the right characteristics to do that. That it's using kind of our existing infrastructure. The other angle is it creates dislocations. Right? The problem with fast productivity gains is you get unemployment, at least for a while. Most of history would say two things. One, it's very hard to stop even if you wanted to. So there was like the Luddite movement in the late 1800s. It slowed down growth for a while, but it eventually automation and electrification and these type of things were so useful that they continued. But also, even if you can't slow it down, the key is to find new industries that didn't exist when you started. So as an example, in 1850, half of the economy was employed in agriculture. Today it's 1%. But the 1% that's in agriculture produces an enormous amount of food because they're super productive. You have genetically engineered seed, you have massive combines, you have GPS tractors, you have better weather forecasts. And so we don't miss the farming jobs because we have other jobs. We have jobs that didn't exist back then, like a software programmer or just-in-time inventory manager or research scientist. Strategist, yeah. So the key is to create new jobs. And create new productive jobs. Create new jobs that themselves raise living standards. So that's a process as well. But I'm talking about a lot of pieces that have to fit together. And that's why I'd frame it as the base case is, we have an economy that, especially with big deficits and aggressive fiscal policy, will at some point probably threaten a second inflation wave. But let's watch the non-farm business productivity data. Let's watch gross domestic income, because that was one of the ways in the 1990s you were able to pick up in closer to real time that productivity was accelerating. Gross domestic income was outperforming gross domestic product. So let's look for some sign in the data that that's happening. But it's a puzzle that has to fit together quickly and appropriately.
We have a question here, and I think time for one more.
Okay.
Yeah, what's your outlook for India over the next 5 to 10 years?
I would be positive. I think you're likely to pick up some of the dislocation from China. You have, Janet Yellen called it friend-shoring instead of reshoring. There should still, one of the most important economic concepts is the idea of comparative advantage. And so if we're trying to do trade differently, we have to look for places that have a comparative advantage that are in the friend-shoring category. And at least for now, I'd say India would start to check that box. Other parts of Asia as well. But I don't think it'll be as simple as what has happened with manufacturing, especially of non-durable goods in China. I think that story's played out. But finding the next China is a very interesting play here.
Don, thank you for speaking with us. Two-part question. One, the Middle East is a hornet's nest. I haven't checked my phone to see if the U.S. and Iran are in an actual shooting war or just a proxy war. How does that impact things, especially inflation? And then second part, Fed balance sheet, 7.7 trillion-ish, 80 billion runoff. How does management of that?
Sure, yeah, okay. So first on the Middle East, so the most recent issue with the Red Sea, I would view as first a European issue. The trade channel that you're impacting first goes from Asia to Europe. So if we're going to see supplier delivery times rise, or we're going to see shortages or things like that, I think we would look at the European data as a leading indicator for what would be coming here. So far, so good. I mean, the French inflation rate was fine this past week. So it may be coming. Right? This is a relatively new development, but it's not lasted so long that it's impacting the data yet. Fed balance sheet, operations here are also dependent on the Treasury. So this is where the Treasury quarterly refunding has become a much more important announcement. It used to be a very technocratic announcement. And now, depending on how the Treasury issues bills versus longer dated bonds, you'll either drain the reverse repo facility or not. It looks like with the latest announcement, QT is going to continue. So the Fed likes it on autopilot. They don't view it as a tool that is an active monetary policy tool. They view it as a passive monetary policy tool. And so the Fed's preference would be to leave it run on autopilot, but I think it's going to depend much more on the Treasury and the quarterly refunding announcement for when it stops. I mean, maybe the earliest would be mid this year for a taper of the QT, in other words, reduce the pace, something like that. But the Fed, if they had their way altogether, I think would just let it run. Let me say thank you. I appreciate the chance to talk to the group tonight. I'll turn it back to
Hey, Don, if you want to stay up there. Hey, Don, thank you as a token of our appreciation. The board has to get for you, so thank you. So we are a couple of minutes ahead of time due to productivity improvements. So just you're welcome to stay, finish your dessert, and a reminder to fill out your card as well and hand it in. Thank you, everyone, for coming. Look forward to seeing you next year.